This week, we are studying Chapter 12, which deals with accounting for partnerships. The first thing we'll do is identify the characteristics of partnerships and similar organizations. Partnership is an unincorporated association of two or more people to pursue a business for profit as co-owners. Many businesses are organized as partnerships. They are especially common in small retail and service businesses. Many professionals, including physicians, lawyers, and accountants, also organize their practices as partnerships. A partnership is a voluntary association between partners. Forming a partnership requires that two or more people agree to become partners. Their agreement is a partnership agreement. Although it should be in writing, the contract is binding even if it's only expressed verbally. Partnership agreements normally include details of the partners' names and contributions, rights and duties, sharing of income and losses, withdrawal agreement, dispute procedures, admission and withdrawal of partners, and the rights and duties in the event that a partner dies. A partnership does not pay income taxes. The income or loss of a partnership is allocated to the partners according to the partnership agreement. It is included on each partner's tax return. Partners are taxed each year whether or not cash is distributed to partners. The life of a partnership is limited. Death, bankruptcy, or any event disabling a partner ends the partnership. Mutual agency means that each partner can bind the partnership to any contracts. Unlimited liability means that when a partnership can't pay its debts, creditors usually can take partners' personal assets. Co-ownership of property means that partnership assets are owned jointly by all partners. There are different forms of partnership that can be done. So a general partnership is an entity where all partners have mutual agency and limited liability. Some individuals who want to invest in a partnership are unwilling to accept the risk of unlimited liability. Their need can be met with a limited partnership. This type of organization is identified LTD for limited or LP. A limited partnership has general and limited partners. At least one partner must be a general partner who assumes management duties and limited liability for the debts of the partnership. The limited partners have no personal liability beyond the amounts that they invested in the partnership. Most states allow individuals to form a limited liability partnership. This is identified by LLP. This type of partnership protects innocent partners from malpractice and negligent claims resulting from the acts of another partner. When a partner provides services resulting in a malpractice claim, that partner has personal liability for the claim. The partners not responsible for the claim are not personally liable to it. Accounting for an LLP is the same as a general partnership. A limited liability company, or an LLC, has features similar to a corporation and others that are similar to a limited partnership. The owners, who are called members, have limited liability and can have management duties. For income tax purposes, an LLC is generally treated as a partnership. And so a lot of companies, that's what they'll try to form as an LLC. Now, an S corporation, or corporation with 100 or fewer owners who choose to be treated as a partnership for income tax purposes. C corporations are different from S corporations. S corporations provide owners the same limited liability feature that C corporations do. The advantage of an S corporation is that it does not pay corporate income taxes. Choosing to form a business form. Choosing the proper business form is crucial. Choosing the proper business form is crucial. Many factors should be considered, including taxes and liability risk. The table shown summarizes several important characteristics of these business entities. So again, we see that a general partnership has unlimited liability, and they don't pay business taxes. It goes on to the person's personal income tax return. And then for an LP, they have limited liability somewhat, and then again, same thing with the business. It's done on personal income tax. LLP has limited liability, still personal income tax. LLC has limited liability, personal income tax. And S Corp, limited liability, personal tax. And an S Corp or C Corp is one where it has limited liability, and the business, you have to pay business taxes. And we'll talk about C Corps, which are a form of corporations. We'll talk about that in chapter 14. Prepare the entries now in order to form a corporation. When partners invest in a corporation, their capital accounts are credited for the amount that is invested. Partners can invest both assets and liabilities. Each partner's investment is recorded at market value of the contributed assets and liabilities at the date of the contribution. Net income or net loss is allocated based upon the partnership agreement. So organizing a partnership. Kayla Zane and Hector Perez organize a partnership on January the 11th called Boards that offers year-round facilities for skateboarding and snowboarding. Zane's initial net investment in Boards is $30,000, made up of $7,000 in cash, the boarding facilities investment $33,000, and a note payable reflecting a bank loan for the new business of $10,000. Perez's initial investment in cash is $10,000. These amounts are the values agreed on by both partners. The entries to record these investments are shown here. So we see, first of all, is the investment for Zane. And so we see that cash is debited $7,000, the boarding facilities is debited $33,000, and then the notes payable of $10,000, because that's the bank loan, and then is credited, and then K Zane capital of $30,000. And then Perez is debited in the amount of cash in the amount of $10,000, and H Perez capital is credited for $10,000. In accounting for partnerships, the following additional relationships hold true. Partners' withdrawals are debited to their own separate withdrawal account. So it'll be separate. It'll be similar to what we've done before, but this time it'll be separated out. Each partner will have their own individual withdrawal account. Partners' capital accounts are credited or debited for their share of net income or loss when closing the accounts at the end of the period. So again, it would be proportioned to them. We'll see that in a minute. Each partner's withdrawal account is closed to the partner's capital account. Separate capital withdrawal accounts, again, are kept for each partner. So now allocating and recording income or loss among partners. Partners are not employees of the partnership, but they are the owners. So they have, for the partners, they wouldn't have any salaries reported as expense on the income statement, but the profits and losses of the partnership are divided on some agreed upon ratio. So partners can agree to any method of dividing income and loss. If there's no agreement, income or loss is divided equally 50-50. Three common methods to divide income and loss use a stated ratio basis, a ratio of the capital balances and the salary and interest allowance, and any remainder according to the fixed ratio. We'll explain each of these methods in this section. Now, a stated ratio, also called an income and loss sharing ratio, the profit and loss ratio, or the P&L ratio. Measure method of allocating partnership income or loss gives each partner a fraction of the total. Partners must agree on the fractional share each receives. To illustrate, assume the partnership between K. Zane and H. Perez says that Zane receives 2/3 and Perez 1/3 of partnership income and loss. If their partnership's net income is $60,000, it is allocated to the partners when the income statement account is closed as shown. So we see income summary $60,000. So that would show us the profit at the end of the year, which in this case is December 31. And then we see K. Zane capital, 2/3 of 60,000 is 40. So we credit that to her capital. And then H. Perez capital, 1/3 of 60 is 20,000. We credit that to his capital. Now, the capital balances method of allocating partnership income or loss based on the ratio for each partner's relative capital balance. If Zane and Perez agree to share income and loss on the ratio of their beginning capital balances, Zane's 30,000 and Perez's 10, Zane receives 3/4 of all income and loss. So again, 30,000 divided by 40,000, and Perez receives 1/4, 10,000 divided by 40,000. And so we see that shown here. So you take the balance of how much of the capital account, 30,000, and then 10, and then we see the total is 40,000. And so of that, 75% is K capital, 25% is Perez, and any amount of income. So you take the income multiplied by the amount ratio, that gets your allocation for the income. And then you would, to close out the income summary, you would have income summary debit, the amount of 60, and then you'd credit K. Zane capital, 45, and H. Perez capital, 15,000. Now, let's look at a more complex and realistic way that partners may decide to divide profits and losses. Zane and Perez have a partnership agreement in which they have the following conditions. Zane receives a $36,000 annual salary allowance, and Perez receives an allowance of $24,000. Each partner is allowed an annual interest allowance of 10% on their beginning capital balance. Any remaining balance of income or loss is allocated equally, and they have a net income of $70,000. Okay, so we begin with the $70,000 of income to allocate to the two partners. Next, we provide an allowance for salary of $36,000 to Zane and $24,000 to Perez. After this allowance, we have $10,000 remaining to be allocated to the partners. Next, we provide the interest on beginning capital. Zane will receive an allocation of $3,000, so that's $3,000 is 10 times beginning balance of $30,000. Perez of $1,000, 10 times beginning balance of 10. After this allocation, we have $6,000 remaining. We allocate $3,000 each partner. When the allocation is complete, Zane will have income of $42,000. Perez will have income of $28,000. So now let's look at this, but with a different amount of only $50,000. Now we begin with $50,000 instead of $70,000 in our previous example of income to allocate to the two partners. First, we provide an allowance for salary of $36,000 to Zane and $24,000 for Perez. After this allowance, we have a negative $10,000 remaining to allocate to the partners. Next, we provide the interest on beginning capital. Zane will receive an allocation of $3,000, Perez of $1,000. After the allocation, we have a negative $14,000 remaining to be allocated. Finally, we allocate the negative 14,000 equally between Zane and Perez. Each partner will receive a reduction of 7,000. So we see that Zane has income of 32 and Perez has income of 18,000. Partnership financial statements. Partnership financial statements are similar to those of other organizations. The statement of partners' equity, also called statement of partners' capital, is one exception. It shows each partner's beginning capital balance, additional investment, allocated income or loss, withdrawals, and ending capital balance. To illustrate, this slide shows the statement of partners' equity for boards prepared using the sharing agreement discussed earlier. Recall that board's income was 70,000. Also assume that Zane withdrew 20 and Perez 12 at year end. The equity section of the balance sheet of a partnership usually shows the separate capital account balances for each partner. In this case of boards, both K Zane Capital and H Perez Capital are listed in the equity section along with their balances of 52 and 26 respectively. So now, accounting for the admission of partners. A partnership is based on a contract between individuals. When a partner is admitted or withdraws, the present partnership ends. Still, the business can continue to operate as a new partnership consisting of the remaining partners. A new partner is admitted in one or two ways: by purchasing an interest from one of the more current partners or by investing cash or other assets into the partnership. The purchase of partnership interest is a personal transaction between one or more current partners and the new partner. To illustrate, at the end of board's first year, H. Perez sells half of his partnership interest to Terrell Hashid for $18,000. This means that Perez gives up a $13,000 recorded interest, $26,000 divided by 2 in the partnership. See the ending capital balance above. The partnership records this January the 4th transaction as follows. After this entry is posted, board's equity shows K. Zane Capital, H. Perez Capital, and T. Rashid Capital, and their respective balances of 52,000, 13,000, and 13,000. One aspect of this transaction, two aspects of this transaction are important. First, the partnership does not record the 18,000 that Rashid paid Perez. The partnership's assets, liabilities, and total equity are unaffected by this transaction among partners. Second, a new partnership, including Rashid, is formed and a new income and loss sharing agreement is prepared. Admitting a partner by accepting assets is a transaction between the new partner and the partnership. The invested assets then do become part of the partnership property. So here, if you're just selling an interest to the partnership as a partner, the money that's received is not considered part of the partnership, but you do, because Perez sold half of his interest, he has to give half of that over to Rashid. And so you'd divide it and then create another capital account then for Rashid. Now, in this case, if somebody is investing assets into the partnership, it does affect the partnership, and so they do have to add that in to the partnership. If Zane with a 52,000 interest and Perez with a 26,000 interest agreed to accept Rashid as a partner in boards after an investment of 22,000 in cash, it would be recorded as shown here. After this entry is posted, both assets, cash, and equity, T. Rashid Capital, increased by 22,000. Rashid now has a 22% equity in the assets of the business, computed as 22,000 divided by the total equity. Rashid does not necessarily have a right to 22% of the income. Dividing income and loss is based upon a separate agreement. So you have cash debit of $22,000 and then T Rashid capital of $22,000. Now, bonus to old and new partners. When the current market value of a partnership is greater than the recorded amounts of equity, the partners usually require a new partner to pay a bonus for the privilege of joining. When the balance in the new partner's capital account does not equal the amount of net assets invested, the difference is called a bonus, either to or from the current partners. To illustrate, assume that Zain and Perez agreed to accept Rashid as a partner with a 25% interest in boards if Rashid invests $42,000. Recall that the partnership's accounting records show that Zain's recorded equity in the business is $52,000. Perez's recorded equity is $26,000. Rashid's equity is determined as follows. Although Rashid invests $43,000, the equity attributed to Rashid in the new partnership is only $30,000. A $12,000 difference is called a bonus and is allocated to the existing partners, Zain and Perez, according to their income and loss sharing agreement. A bonus is shared in this way because it is viewed as reflecting a higher value of the partnership that is not yet reflected in income. Bonus to old partners. So we know that Rashid will pay $42,000 cash into the partnership and receive a capital balance of $30,000. The difference is $12,000 and is attributed to the existing partners, Zain and Perez. Both Zain and Perez will be given credit for half of the $12,000 or $6,000 each. So to record, you would have debit cash the amount of $42,000 and then credit T Rashid capital for $30,000 and then credit the K Zain capital for $6,000 and the H Perez capital for $6,000. Alternatively, existing partners can give a bonus to a new partner. This usually occurs when they need additional cash or the new partner has exceptional talents. The bonus to the new partner is in the form of a larger share of equity than the amount invested. To illustrate, assume that Zain and Perez agreed to accept Rashid as a partner with a 25% interest in the partnership, but they require Rashid to invest only $18,000. Rashid's equity is determined as shown. Let's prepare the entry to admit Rashid into the partnership. His equity balance then would be $24,000. And so to record the journal entry, the old partners contribute the $6,000 bonus, $24,000 minus the $18,000 to Rashid, according to their income and loss sharing ratio. The entry to record the admission and investment of Rashid is shown. So you have cash, the amount of $18,000, because that's what Rashid is contributing, and then you will also debit the K Zain capital for $3,000 and the H Perez capital for $3,000, because that's half of $6,000 for each of them, and then you'll debit the T Rashid capital for $24,000, and so that records Rashid's admission and bonus. Count for the withdrawals of partners, or the withdrawal of partners. Now, a partner generally withdraws from a partnership in one or two ways. First, the withdrawing partner can sell their interest to another person who pays for it in cash or other assets. For this, we need only debit the withdrawing partner's capital account and credit the new partner's capital account. And then also cash or other assets of the partnership are distributed to the withdrawing partner in payment for his or her interest. To illustrate these cases, assume that Perez withdraws from the partnership of boards in some future period. The partnership shows the following capital balance at the date of Perez's withdrawal: K Zain $84,000, H Perez $36,000, and T Rashid $38,000. The partners, Zane, Perez, and Rashid, share income and losses equally. Accounting for Perez's withdrawal depends on whether a bonus is paid. We described three possibilities. No, and so this one would be for no bonus. If Perez withdraws and takes cash equal to Perez's capital balance, the entry is shown. Perez's withdrawal creates a new partnership between the remaining partners. A new partnership contract and a new income and loss sharing agreement are required. So you would have to debit H. Perez capital for $38,000 and then credit cash $38,000, and that records that you're paying Perez out his capital. Now, when a withdrawing partner takes less than the recorded value of their equity, they are in effect giving the remaining partners a bonus equal to the equity left. The bonus is distributed according to their income and loss sharing agreement. To illustrate, if Perez withdraws and agrees to take $34,000 cash in payment of Perez's capital balance, the entry is shown. Perez withdrew $4,000 less than Perez's recorded capital of $38,000. This $4,000 is divided between Zane and Rashid according to their income loss sharing ratio. So you would have to debit the H. Perez capital $38,000, credit cash for $34,000 because that's what you're paying H. Perez, and then you would also credit the K. Zane capital $2,000 and the T. Rashid capital $2,000, because now they would divide everything up 50-50 because there's just the two of them now. Now, when a withdrawing partner receives more than a recorded value of their equity, they are receiving a bonus. The remaining partners reduce their equity by the amount of this bonus according to their income and loss sharing agreements. To illustrate, if Perez withdraws and receives $40,000 cash in payment for Perez's capital balance, the entry is shown. And so we see we have H. Perez capital of $38,000, and then we have K. Zane capital of $1,000 debit, T. Rashid capital $1,000 debit, and in cash $40,000. So that records the amount that H. Perez is receiving. So it closes out his capital account, and then you also have to take from K. Zane and T. Rashid's capital in order to pay the bonus. Now, what happens when a partner dies? A partner's death dissolves a partnership. A deceased partner's estate receives their equity. The partnership contract should state how to deal with the death. This can involve selling the equity to remaining partners or to an outsider, or it could involve withdrawing assets. So we'll prepare entries for partnership liquidation. When a partnership is liquidated, its business ends, and three steps are required. The first step is to record the sale of non-cash assets for cash. Gain or loss on liquidation is allocated to partners using their income and loss agreements. Pay all partner liabilities and distribute any remaining cash to partners based on their capital balances. No capital deficiency means that all partners have a zero or credit balance in their capital accounts for final distribution of cash. To illustrate, assume that Zane, Perez, and Rashid operate their partnership and boards for several years, sharing income and loss equally. The partners then decide to liquidate. On the liquidation date, the current period's income and loss is transferred to the partners' capital accounts according to their sharing agreement. After that transfer, assume the partners' recorded account balances immediately prior to liquidation are shown. We apply three steps for liquidation. So the first is the partnership sells its assets, and any losses or gains are shared among partners according to their income and loss sharing agreement, equal for all partners. Assume that boards sells its non-cash assets consisting of $40,000 in land for $46,000 cash, creating a net gain of $6,000. In a liquidation, gains and losses result from the sale of non-cash assets are called losses and gains from liquidation. The entry to sell its assets for $46,000 is the first one that's shown. And then the allocation of the gain from the liquidation per the partner's income and loss sharing agreement is shown second. So we see, first of all, to sell the assets, the land, we have to debit cash the amount of $46,000 because that's the amount of cash that we're receiving. We credit land $40,000, so that now zeroes out the land asset account, and then we have to credit the gain from liquidation of $6,000 because we sold it for more than what it was, the book value of it was. So then, in order to split that then amongst the partners, we will debit the gain from liquidation, $6,000. So now the gain from liquidation now is zero. And then we will then go ahead and credit then a proportion of that according to their agreement. In this case, they divide everything equally. So 1/3 of it to each partner, so 3 partners. We would credit that. So K Zane Capital, $2,000, H Perez Capital, $2,000, and T Rashid Capital, $2,000. Now, the partnership also has to pay its liabilities, and any losses or gains are shared among partners according to their income and loss sharing agreement. Board's only liability is $20,000 in accounts payable, and no gain or loss occurred. The entry is shown first on the slide. After step 2, we have credit balances available with the remaining cash balance shown in the second graphic. And then third, any remaining cash is divided among the partners according to their capital account balances. The entry to record the final disbursement of cash is shown last. Remember that it is important to remember that the final cash payment is distributed to partners according to their capital account balances, whereas gains and losses from liquidation are allocated according to the income and loss sharing ratios. So we see the first one, we go ahead and we pay off the accounts payable, so we'll debit the accounts payable, $20,000, credit cash $20,000. So debiting the accounts payable then makes the accounts payable 0, okay? And then we see the amounts then in each of the partners' capital accounts. So K Zane has capital of $72,000, H Perez has capital of $68,000, T Rashid $64,000. So we'll debit the capital accounts for each partner, and then we'll credit cash for the total. So that closes out the amount of capital then that each owner had. Now, capital deficiency. Capital deficiency means that a partner has a debit balance in their capital account at the point of final cash disbursement during step 3 in the prior section that we looked at just a minute ago. This comes from liquidation losses, withdrawals before liquidation, or reoccurring losses in prior periods. A partner with a capital deficiency must pay cash into the partnership. So we see here that to illustrate, assume that Zane, Perez, and Rashid operate their partnership and boards for several years, sharing income and losses equally. The partners then decide to liquidate. Immediately prior to the final distribution of cash, the partners recorded capital balances of $19,000 for Zane, $8,000 for Perez, and negative $3,000, so it would be a debit balance for Rashid of $3,000. Rashid's capital deficiency means that Rashid owes the partnership $3,000. Both Zane and Perez have a legal claim against Rashid's personal assets. The final disbursement of cash in this case depends on how this capital deficiency is handled. 2 possibilities exist. The partner pays the deficiency, or the partner cannot pay the deficiency. So first of all, we'll assume that the partner pays the deficiency. If Rashid is willing and able to pay the $3,000 deficiency, the entry to record receipt of payment from Rashid is shown. So we see that we would debit cash the amount of 3,000 because we're receiving cash for 3,000, and we'll credit T Rashid Capital for 3,000. So that would then bring, since T Rashid had a debit balance of 3,000, and if we credit T Rashid 3,000, then T Rashid Capital then has 0. Okay. So that would be the first part of that. And then the second portion of that shows then how we would distribute the payment. So in the process of liquidation, a capital deficiency means that, okay, I'll read that. So then we see then the remaining then would be paid to the other two partners. So K Zane Capital is debited 19,000 because that then closes out her account. And then H Perez Capital is then debited 8,000, and we credit cash 27 because we're paying them their positive balances that they had, and then K Rashid Rashid had to pay in, so we don't pay him anything then when we at the end. So in the process of liquidation, a capital deficiency means that at least one partner has a debit balance in his or her capital account. A partner with a deficit must, if possible, cover the deficiency by paying cash into the partnership. In our liquidation, Zane has a capital balance of 19, Perez 8, and Rashid a debit balance negative would be negative 3,000. Rashid owes the partnership 3,000 and is able to pay the amount. Let's look at the entries to liquidate the partnership shown on this slide. So we talked about that. Now let's say that the partner that has it can't pay. So now if the partner cannot pay the deficiency, the remaining partners with credit balances absorb any partner's unpaid deficiency according to their income and loss sharing ratio agreement. If Rashid is unable to pay the 3,000 deficiency, Zane and Perez absorb it. Because they share income and loss equally, Perez and Zane each would have to absorb $1,500 of the deficiency, and that is recorded as shown. And so we'd see K Zane Capital debit 1,500, H Perez Capital debit of 1,500. So we debit each of those for the loss in proportion. In this case, we do half of the loss of the deficiency, and then T Rashid Capital, we can credit that then for 3,000, and then that makes T Rashid's capital balance then 0. Now, after Zane and Perez absorb Rashid's deficiency, the capital accounts of the partners are that for Zane has 17,005, Perez has 6,500, and Rashid has 0. The entry for the final cash distribution to partners is shown second. And so we see that you have then K Zane Capital debit the amount of 17,500, H Perez Capital debit of 6,500, and then you'll credit cash 24,000. Okay, because that then clears out the amount, then makes 0 K Zane Capital makes 0 H Perez Capital, and then records the payment of cash to those partners. Now, remember that Rashid's inability to cover this deficiency does not relieve Rashid of the liability. If Rashid becomes able to pay at a future date, Zane and Perez would each be able to collect $1,500 from Rashid. We'll compute the partner return on equity and use it to evaluate partnership performance. We can calculate the return of partner's equity by dividing partner net income by the average partner capital balance. Partner return on equity ratio helps current and potential partners evaluate the success of a partnership compared to other investments. This measure is separately computed for each partner. To illustrate, this slide reports selected data from Boston Celtics LP. The return on equity for the total partnership is computed as 216 divided by, and then 85 plus 253 divided by 2 equals 127.8%. However, return on equity is quite different across the partners. For example, the Boston Celtics LP1 partner return on equity is computed as $44 divided by, and then in parentheses, 122 plus 166, close parenthesis, divided by 2 equals 30.6%, whereas Celtics LP partner return on equity is computed as, anyway, 36.8%. Okay. Partner return on equity provides each partner an assessment of its return on its equity invested in the partnership. A specific partner often uses this return to decide whether additional investment or withdrawal of resources is best for that partner. This exhibit reveals that the year shown produced good returns for all partners. The Boston Celtics LP2 return is not computed because its average equity is negative due to an unusual and large disbursement in the prior year.